In the sixth and final video of the course section devoted to consolidation workings, we continue our exploration of the adjustments and workings required when preparing the consolidated income statement and more broadly the consolidated statement of comprehensive income. In addition to the already discussed adjustments required in respect of the transfer of goods, further profit and loss adjustments may be required when group enterprises carry out transfers of non-current assets at prices which deviate from their existing book values. Consider the following brief example. The parent sells an item of property, plant and equipment to a wholly owned subsidiary for a price of €6,000. Prior to the sale, the asset was carried at €4,000 in the books of the parent and has a remaining useful life of 2 years. The above transaction generates the following two accounting issues. First, the parent's income statement includes a profit of €2,000 which needs to be eliminated from the consolidated financial statements of the group. And second, the asset is now carried in the books of the subsidiary at an inflated price relative to the value previously reported in the statement of financial position of the parent. Adjustments are therefore required to return the numbers reported in the group financial statements to a situation as if the sale had not taken place at all. Immediately after the transfer, this is achieved by means of a debit of €2,000 to the parent's reported profit and corresponding credit to consolidated non-current assets. Following the first year, however, the adjustments required become progressively smaller as the gain generated upon the sale by the parent is gradually realized by the higher depreciation charges booked by the subsidiary, which are based on a carrying amount that includes the intra-group profit element. Let us now consider some of the additional adjustments which may potentially be required at the consolidated income statement level. You should recall that goodwill is a non-current intangible asset, which appears in the consolidated statement of financial position by means of an adjustment, and is not an item which would be transferred from the assets of either the parent entity or any of its subsidiaries. Accordingly, in the event that goodwill becomes impaired, any associated loss must be booked directly to the consolidated income statement. If the carrying amount of non-controlling interest and associated goodwill was measured under the proportion of net assets method, then the impairment loss will be attributed fully to equity holders of the parent entity and accordingly charged to group retained earnings. If, however, goodwill was initially computed under the fair value method and therefore grossed up to reflect the portion attributable to non-controlling interest, then the impact of any impairment loss will have to be split between consolidated retained earnings and non-controlling interest. Another potential adjustment relates to the depreciation of those of the subsidiary's assets which, upon their initial recognition in the consolidated statement of financial position, were revalued to reflect fair value. The subsidiary's individual income statements will naturally reflect depreciation charges which are based on the carrying amounts of those assets as reported in the individual statements of financial position. An adjustment to the depreciation charge as reported in the consolidated income statement will therefore typically be required. And finally, we should also note that additional adjustments may also be necessary at the consolidated statement of other comprehensive income level, for example, in respect of revaluation gains or losses on items of property, plant and equipment, if the group follows the revaluation model as permitted under IAS 16, but the individual subsidiaries utilize the cost approach instead.